Ladies and gentlemen, welcome to this week's version of Nichols and Dimes, our weekly video series. I'm going to get to that number one question in a minute, but first, the quote of the week, and it talks about logic. Logical thinking helps only in maths, not in real life. Logical thinking only helps in maths, not in real life. How true is that? In many cases. This is by the New Age thinker. I'm not sure who it was, but I thought it was a fantastic quote. So what is the number one question, or what number one thing people ask us today when it comes to the stock market and the economy? That number one question is, I don't understand why the stock market keeps going up when we have tens of millions of people who are, for example, are unemployed, or we see the market as evidenced by the economy struggling a bit, or quite a bit. Here's the reality. Number one, on a positive note, as you know, some places, some parts of the economy are starting to open up. Hopefully, we've got this virus under wraps and at least contained. So things are starting to open up. So as you know, the market is always forward thinking. So in other words, what is going on today usually shows up 9 to 12 months from now in terms of economic production and expansion. So again, the market is always forward thinking. It will appreciate prior to an economic expansion, economic growth. But that's what I think is the minority of the reason that the market's going up. The majority of the reason I think the market's going up is primarily because of one thing, and it's something I mentioned recently in a recent Nichols and Dimes video, and that is because of quantitative easing. It's a fancy way to say the printing of money. So as you know, the Federal Reserve controls short-term interest rates. It also controls the money supply, the amount of money that we have in terms of liquidity in the whole financial system. Well, on March 23rd, when the market was really collapsing, the Federal Reserve came out with a stimulus package to support and enhance the economic environment. They gave loans to small business owners. They helped with individual stimuluses in terms of, credits, depending on your tax-paying situation, to folks from $1,200 to up to $2,400 in that range. So again, the Fed came out with stimulus. What it also did recently was it started buying up exchange-traded funds in terms of bonds, so bond ETFs. So my point is, with the combination of all this stimulus, it added about $7 to $8 trillion of liquidity, meaning actual electronic cash, to the marketplace. So what does that tell us? That tells us that because of this recent appreciation in the stock market, the market likes, meaning sees it as a positive thing, to the equity markets, to the bond markets, to the overall economic situation in general. So what I wanted to do was just give you a little historical perspective on when the Fed comes out with stimulus, so quantitative easing 1, 2, and 3, and so forth, the stock market, generally speaking, positively reacts. So this is a chart going back to 2009. So this chart represents when the Fed came in with various stimulus packages. So you could see back in 2008 and around March of 2009 where the market bottomed, this is when the Fed came out with quantitative easing 1. Again, it's a fancy way to say printing of money. So notice how the market stabilized here and then actually bottomed out around March 2009, and we went basically straight up, with some gyrations, of course. So notice that when QE1, when the first round of money printing ended, the market actually sold off. And then around here, the Fed chair at the time, Ben Bernanke, came out with quantitative easing 2 in terms of his talking about potentially increasing the money supply. Notice how the market stabilized again and then shot up again. Notice here again how quantitative easing round 2 put a let's call it a recent market top around this point. Quantitative easing 2 ended, the market sold off. And notice what ended up happening here: more stimulus, and then over here where quantitative easing end up coming in when Bernanke talked about QE3, if you will, market took off again. And again, what have we seen since March 23rd of this year, when the Federal Reserve Chair, Fed Powell, basically started talking about stimulus, and they started talking about the increasing the money supply. The market bottomed on that day and generally has gone straight up. Also, about 3 weeks ago, a 60 Minutes interview with the current Fed Chair Jerome Powell, where the specific interviewer asked him, are you out of tools, if you will, to help stimulate and stabilize the economy? And his words were something to the effect of, we're not out of bullets. The next day, that was on a Sunday night on CBS, 60 Minutes. The next day, that Monday, the market, as evidenced by the Dow, or as represented by the Dow, was up 900 points. So again, there is a direct correlation between the Federal Reserve stimulus and quantitative easing and, obviously, as we've seen, the market's positive response. And there's a quote or phrase in the industry that we say, don't fight the Fed. Certainly that's the case. So again, in many cases, the market is not the economy. Again, it's always forward thinking, and this is what we're seeing again and again. Don't fight the Fed. The main reason the markets are up is because of Fed stimulus. Look at the recent past. Look what's going on now. So in many cases, again, the market is not oftentimes logical. So to that end, if you would like a second opinion on your portfolio, you could send me an email, cnichols@nicholswealth.com, or go on our website, click on the services tab, click on second opinion service, and you can reach out to us that way. Again, thanks for watching. Have a great day.